Hey YouTube, what is up? Now, I see commonly, probably every day at least online, that people keep banging on about how price is fractal across all time frames. And yes, they're right in theory and they're right on paper, but there's a big drive online in the trading industry, which isn't the healthiest, as you know, but there's a big drive online that lower time frame trading, ICT trading, 1 minute time frames, 5 minute, 15 minute. And all these traders eventually never make it. And traders that have been going down that route for many years, again, don't find the success and the results they want. So I'm going to dive in today as to why, yes, price is fractal, but how you make sure you don't get stung and how you actually make sure that your calling direction is right and you're getting your entries optimally and not entering too early and hence getting stopped out prematurely because you're trading too lower. So pen and paper for this one, guys, and make sure you watch to the end because there's quite a few gems I want to go through. Now, because there's such a big thing online around how, as I said, price is fractal across time frames, people then take that as, right, I'm only going to look at lower time frames. I might look at my daily bias. I see a lot of that online as well, where people say, I've checked my daily bias, but I'm trading off the 1 minute, 5 minute, 15 minute. That's not good enough. That is not enough. And this is why you're still seeing inconsistency in your results and your trading. Let me explain. When you look on time frames like the daily and the 4 hour, so I class higher time frames as the 4 hour, the daily, and the weekly. Obviously the monthly, of course, as well. But when you look at the 4 hour and the daily and you zoom out onto those perspectives, you will see that price swings most of the time pretty nicely. So in a bullish market, of course, high highs, high lows, high highs, high lows, etc. Bearish market, you get the picture. Now, when you go on to any time frame, probably sub 1 hour, 30 minute, you don't get to see that as often. And I would argue actually it's fairly rare. So when you do see it, it's not common at all. Now, let's say again, we're in a 4 hour nice swinging bullish market, all right? Obviously in a bullish market, you obviously want to be taking longs and you want to be taking longs off the higher lows that are formed for the best risk to reward. Obviously the deeper the retracement and the better the entry on the deeper the retracement, the better the smaller the stop loss and the better the targets, again, better RR. But that's for another video. My point is, if we are currently on a 4 hour and we are currently at where a higher high has been formed, okay, so a new bullish leg has finished, the higher high has been made, we now expect, obviously, markets to come to retrace lower and form a higher low. Now, on the 4 hour and the daily, or even the 1 hour, a typical retracement can be anywhere between 40, 50 pips to 80, 90, 100 pips, sometimes bigger. And that's fine. That's normal. That's completely healthy. That's completely normal. And what lower time frame traders do, though, because they're so doubled down on 1 minute, 5 minutes, 15 minutes, you can't see that. So if we were to box off the same area of price, but on the smaller time frames, you can't see where on that 4 hour pullback you are in. And a lot of time, lower time frame traders then, they're taking longs, as they should be, because we're in a bullish market. So they've got the trend right, but they're taking longs near the higher highs on the 4 hour and the daily, but they don't realize that because they're so doubled down and tunnel visioned on the lower time frames. Whereas if they just maybe started trading maybe more 30-minute 1 hour, I'd argue even higher, 1 hour, 4 hour, you're then less likely to get stung. You're then less likely to get really premature entries because on the 1 minute and the 5 minute, when it starts retracing, because obviously the 4 hours, have due a pullback. Obviously, for the 4 hour to pull back, the lower time frames have to pull back first. Hence, then the 1 hour does, then the 4 hour does, and so on and so on and so on. You all know that, I'm sure. But the point here is when they start seeing these lower time traders start seeing a 1 minute pullback or a 5 minute pullback, it looks quite extensive because obviously every candle is printed every minute or every 5 minutes. So it looks like you're having quite a deep pullback in a healthy way and that you're forming that next higher low. But if you just zoom out a few time frames to the 1 hour and the 4 hour, you'll see that price has barely started retracing. And this is why so many of you traders get caught out. You're so much better off trading 1 hour, 4 hour daily and the weekly in my eyes. Obviously, I'm very much more of a swing trader though, because everything's much clearer. You know where price is typically going to retrace into. You know where price is typically going to stop. And of course, Breaks of structure, which are important. They're great ways of confirming trend confirmations or breaks of trends or continuations and all that good stuff that I'm sure you all know. But breaks of structure, for example, they're not trustworthy on anything below the 4 hour. And I mean that. Even the 1 hour is quite choppy at times. It can break structure to the upside, then to the downside, then to the upside, fairly quickly. And we can't trust that. So it's only the 4 hour and the daily and the weekly where breaks of structure from all the tens of years of back testing I've done, and I've obviously been trading for over 10 years now as well. It's only on the 4 hour daily and the weekly where, in my eyes, it's trustworthy. So I only look at breaks of structure or breaks of trend or invalidations of setups when the 4 hour or the daily has had body closes. Anything lower, including the 1 hour, is not enough. It's not trustworthy because a lot of the time price can push a lot lower, but actually by the time the 4 hours closed, it's still respecting that area of interest or that fib level or whatever it is, whatever your confidences are. So I just wanted to hop on here today because I see so much noise out there, and because there's so much noise out there about this stuff, your beginners and even your intermediates who are 2-3 years into trading are going to take that as gospel and face value, and they're going to really focus on the 1 minutes and the 5 minutes. And trust me, you're setting yourself up for long-term failure. And I'd rather you learn this lesson now than instead of learning it in 6 months' time, years, 2, 3, 4 years. It's a huge amount of time wasted when actually in these next 6 months you can be massively bettering yourself and refining and tuning your trading. So guys, I hope that helps. Wanted to keep it fairly succinct today, short and sweet. Of course, if you want my sort of community or my analysis each week, trade setups, all that good stuff, link is in the bio to my community. I've also got a free newsletter as well if you want to sign up. As always, guys, I will catch you on the next one.